All right, so like I said, we're going to talk about investment appraisal. We're going to understand what we mean by what is an investment and how do businesses appraise investments. All right, so that's what we're going to look at today, which is unit 10.1 of our textbook. All right, so let's jump right into it. What does appraisal mean? What is the meaning of appraisal? The English word appraisal. So let's start from there so that we can have a basic understanding of what we're trying to do here. To appraise something is to assess something or someone. All right. So in most companies at the end of the year, they talk about performance appraisal. That is, they are assessing your performance. In this case, we are not assessing the performance of the business, we are assessing an investment. All right. So the first point here is that these investment appraisals are techniques that businesses use to make major investment decisions. These are techniques that businesses use to make major investment decisions. And what do we mean by investment now that we have an understanding of what an appraisal is? So we would understand in this lesson why businesses undertake investment programs, and then we will look at some financial, which is basically mathematical. There will be more formulas in this lesson. Some financial and non-financial methods of assessing whether an investment is worthy or not. So financial and non-financial methods of assessing the worth of alternative investment projects. Businesses have capital. What they put their capital to is what we refer to as investment. What are they putting the capital to? What is the business using its capital to buy? Is it buying a non-current asset? Is it buying another business? Or is it investing in a new technology? So investment basically entails business managers taking major decisions such as deciding to purchase part or all of another business, perhaps as a result of a takeover or an acquisition. We talked about acquisitions, takeovers, and mergers, and all those things in the AS level. So when a business makes a decision to buy part of another business, it is making an investment decision. When a business takes a decision that it wants to acquire, it wants to take over, it wants to buy another business, we are saying or we are referring to this act as making an investment decision. So we are going to look at what processes do business go through before they make such investment decisions. Before one business will decide to buy another business, what informs the decision? How does it appraise? And we said appraisal is to assess. How does it assess whether it is worthy of making that business decision or not? We are also going to refer to investments, or we're going to refer to the purchase of a non-current asset, the purchase of a non-current asset as an investment. I want the marker, not the pen, the highlighter. So we're going to refer to the purchase of a non-current asset. We know the difference between a current asset and a non-current asset. Non-current assets used to be called fixed asset. No more. They are called non-current assets. They are going to be used in the business for more than the short term. They're going to be in the business for a long time, 5 years, 10 years. Say the purchase of a vehicle, the purchase of a machine, etc. So investment in this lesson is going to be whether a business should purchase part or all of another business, or whether the business should purchase a non-current asset. Commonly, it's going to be the purchase of a non-current asset. So this point says more commonly, investment refers to the purchase of a non-current asset or some major decision. The common denominator here, what runs through both of the two, that is whether it is purchasing another business or whether it is purchasing a non-current asset, the common denominator here is that all investment programs involve some level of risk. All investment programs involve some level of risk. Every business, every investment, every enterprise is risky. What do we mean by it's risky? You have to take note of this definition. Risk here is the chance of a misfortune occurring. The chance of a misfortune occurring, possibly resulting in a financial loss. All right. So risk is an unknown event or something that will happen in the future that which is unknown, which is likely to result in financial loss. So the definition is that risk is a chance of misfortune occurring, possibly resulting in financial loss. So what we are saying is that whether a business is taking over another business, that is purchasing another business, or whether the business is purchasing a non-current asset, it involves some risk. It could involve in a misfortune. It could result in financial loss in the future. We don't know, but we are hoping that it will not be a misfortune, but rather it will yield some returns, which means it will yield some profits. So let me read the last sentence. It says that the common denominator with all investment programs is that it involves some level of risk, which must be judged against the likely returns. So what is the risk involved in this enterprise? And risk is measurable. We will go on to discuss that risk is not just uncertainty. Risk is not just uncertainty. Risk is measurable. We can put a figure to it that this particular investment would be risky up to this particular figure. It might not be exact, but risk is measurable compared to just the enterprise or the business or the investment being uncertain. All right. We are hoping that that business, that investment will give us some returns. However, it will also involve some risk, some risk. All right. So that is the first point that we would want to make. So when do businesses make investments or take investment decisions? Number one, when the business is contemplating introducing a new product. For instance, I have the Apple Watch here. In 2015, Apple took a decision to launch a new product. Before the launch of the Apple Watch, this particular product was not in the line of products offered by Apple. It was the iPhone, the iPad, the MacBook, the iMac, and all the other Mac products. But when a business contemplates or introduce a new product, we say it is making an investment decision. It would require the business to invest some capital, some of its resources in this new venture. So the Apple Watch or any new product which is introduced by a business is an investment decision that a business has taken. Expansion, the second point here, expansion. When a business decides to expand, it is making an investment decision. The example from our textbook uses Tottenham Hotspur when it's expanded its stadium. So you can see the old stadium here in the top right corner here. That is the old stadium, and we can see the expansion of the stadium, the construction going on here. All right. So this is also an investment decision. And Tottenham Hotspur, the football club in London, invested $1 billion in developing this new stadium. By this expansion, the club hoped that it would be able to generate more sales from selling more tickets because it is increasing the stadium capacity to some 62,000 spectators. And these facts are taken from your textbook. This example, the Apple example is not from your textbook, but the second example, the Tottenham Hotspur example, is taken from your textbook. Then the third way in which business take investment decisions is through spending on promotional campaigns, developing new brands or products, or retraining the workforce. So when a business spends on a new promotion, it has not launched a new product, it is not expanding, but it is investing some resources in promoting its existing product. An example is Coca-Cola. A couple of years ago, they launched a promotional campaign which they call Share a Coke. And Coca-Cola invested some millions in the successful Share a Coke campaign, which boosted its sales. So when a business spends on promotion, on campaigns, or developing new brands or products, or retraining its workforce, it is making an investment decision. And then the last one is investing in technology. And I have an example here, investing in a new technology. Amazon, a couple of years ago, invested in a drone delivery technology. So instead of purchasing buses, hiring a driver, buying fuel, it invested in drones, a new technology where it just enters the GPS of the customer and the package is hooked to the drone, and then the drone delivers the product to the customer's residence or the customer's address. So these are all types of investment decisions taken by businesses, right? These examples represent when businesses take investment decisions. That is, when it introduces new products, when it expands, like we saw in the example of the stadium, when it spends on promotional activities, and then the last one, when it invests in new technology. Obviously, all of these would involve the outflow of cash. Investing in any form will involve the outflow of cash. And like we also said, all investments will also be risky. All investments could result in a misfortune, and it could also result in financial loss to the business. All right. So because all investments are risky, let's look at some types of risk that any business can face. What is risk, and what are the types of risk that we have? Number one, on our slide, the first point says that risk is a chance of a misfortune occurring, possibly resulting in a financial loss. We've already said that. And it is uncertainty that is quantifiable or that can be measured. Risk is uncertainty, the unknown future. But like I said, risk can be measured. We should put a figure to it. We should put a number to it. What is our risk? Is it 5%? Is it 10%? We should be able to quantify our risk, unlike mere uncertainty. All right. So risk is uncertainty that is quantifiable and it can be measured. There are two types of risk that we'll look at. We'll look at systematic risk and specific risk. Specific risk, I would start with specific risk. So let's start from the second one. I will start with specific risk. It says specific risk is associated with a particular project. For example, launching a new product that is entirely new and of which the firm has little experience. So specific risk is associated with a particular project. That's the first thing you should note. Specific risk is associated with a particular project. That means that specific risk is unique to a specific investment or a specific company. A specific risk or specific risk is unique to a specific investment or a specific company. So we can't um, draw parallels across businesses. All right. What is unique to a particular business. The risk that Apple faces will be different from the risk that Samsung will face in introducing a new product. Tesla launched the Cybertruck. The risk that Tesla faces is different from the risk that Apple faces when it launched the Apple Glass, or the Apple that thing they put on their head. Forgotten the name. Now it's becoming sort of a wasted investment for Apple. People are not buying it. They limited the sales of the Apple. I've forgotten the name. They called the name given to it, but I think you know what I'm referring to. People are not buying it. They've expanded sales across the world. They've introduced the product in some global markets apart from the US. But I think that sales is not very good. The thing is ridiculously expensive, in excess of some $3,000, and I think that it is not doing very well. It is becoming a loss investment to Apple. I think so. That loss, which is specific to that product, is a type of specific risk. And then let's talk about systematic risk. It says that systematic risk relates to the environment in which a project will operate. This type of risk could include a loss of sales and cash inflow due to, say, an adverse movement in the exchange rate. So, unlike specific risk, systematic risk affects the entire market or the economy. Unlike specific risk, systematic risk affects the entire economy or the market. All right, so these are the two types of risk. I hope it makes sense. The other point here says that investment appraisal techniques can incorporate risk using probability theory for more accurate predictions. Investment theory or investment appraisal techniques can incorporate risk using probability theory for more accurate prediction. So mathematical models, mathematical formulas and calculations using probability, which is mathematical, should be used to get accurate predictions. Like we said, risk is quantifiable and measurable. So in using probability theory, in using mathematics, we will be able to accurately predict what the risk is. And the last point says that uncertainty is different, unlike risk. Uncertainty is immeasurable. We can't measure uncertainty, and it cannot be included in numerical appraisal techniques. So I've made that point already, that there's a difference between risk and uncertainty, and this is it. Whilst risk can be measured with some degree of accuracy using mathematical models like probability, uncertainty cannot be measured. All right. So you are going into a new business is an uncertain terrain, but you should be able to use these techniques that we're talking about to measure the risk, so that you know if risk is measured, it can be mitigated. All right. If risk is measured, it can be mitigated. Insurance is one of the ways in which risk can be mitigated. So we are going into a transportation business. There is a risk of accidents on the road, but we can buy an insurance policy so that we can minimize our risk. All right, but that is too advanced for this class. Just know that there's a difference between risk and uncertainty. All right, so far so good. Let's look at some ways. We'll first look at the basic methods of investment appraisal. There are about two techniques that we'll look at in under the basic methods. And then we'll look at the third method, which is the discounted cash flow model or discounted cash flow method. We're going to look at three ways in which, or techniques in which investment appraisal decisions are made. We're going to look at the payback technique or the payback method, and then we're going to look at the ARR, also called the accounting rate of return, and then we're going to look at the discounted cash flow model. I'm hoping that we will be able to finish with payback and the accounting rate of return today. Otherwise, just concluding payback today will be just fine. So let me go through the slides so that I don't miss anything. The first point here says that managers have techniques to aid investment decisions and compare opportunities. So resources are scarce. This is basic economics. We learn from economics that resources are scarce. So if a business has $1 million, it could use the $1 million in several ways, or in several investments. However, if the business uses these techniques to appraise the investment, it will be able to make a decision by comparing the different opportunities that it could use that $1 million for. So there are different opportunities that the business could use its resources for, different ventures, different enterprises that a business could spend on. However, it must assess these investment options available to it and then compare which is the best before it throws money at it. How does it do that? It does that using these techniques that we're going to look at. The first one is the payback technique, and then the others which I've mentioned. There's a note here. What does it say? It says that these techniques are valuable, but they do depend on a number of assumptions. All right, so let's look at some three assumptions that must be made before any of these techniques are used. The first assumption says that all costs and revenues can be forecasted easily and accurately for some years into the future. Otherwise, we would not be able to appraise the investment. We should be able to say that, well, this particular business will give us this amount of money in year 1, year 2, year 3, before we can make a decision as to whether it is a good investment or a bad one. I hope that's straightforward and simple enough. So the first assumption is that we should be able to tell, which is forecast easily and with a bit of precision for some years to come, the costs and the revenues that the investment will yield. Assumption number two, it says that key variables, for example, interest rate, will not change unexpectedly. So we are making the assumption that, number one, we can forecast our revenues and our costs. Number two, that certain key variables like the rate of interest will not change. Interest rates will not change unexpectedly. And then the last one, that the business in question is seeking maximum profits. All right, so these are three key assumptions that we will work with whilst looking at these important techniques of appraising investments. Remember, I said appraising is assessing something or someone. Appraising means assessment. So how businesses assess various investment opportunities. All right. Then let's continue with the assumptions. It says first point here says the managers considers two major things before making a decision to invest in another business or in a non-current asset. So what are these two major things that managers at the back of their minds? What do managers have, business managers, finance managers have at the back of their minds when they are considering investments? Number one, they are considering profits, obviously. The total profit earned by the investment over its foreseeable future. So we are throwing $500,000 at this opportunity. How much profit will it give us? Will it give us a profit of 100,000 or just 10,000? Managers have this at the back of their minds anytime they are making investment decisions. Number two, the time it will take to recover that $500,000 that it threw at that opportunity. So, number one, total profits over the foreseeable future. Number two, how quickly the investment will recover, that is, recoup its costs. This occurs when the earnings from the investment exceeds the cost of the investment. The earnings, the revenue should exceed the cost, the money we threw at the opportunity, at the investment. What comes in terms of sales, revenues, etc., should be more than what goes out. And how quickly can we recover our investment? So these are the two things that managers think about. So we will also have these two things at the back of our minds when we are looking at these three techniques: the payback, the accounting rate of return, and then the discounted techniques, the discounted cash flow models. All right. And the last point here says that the process of assessing these factors is called investment appraisal. I think by now it is clear to us what investment appraisal is. The process of assessing these factors, and it says and refers to the process of assessing one or more potential investments. All right. So managers have these two things at the back of their minds whilst thinking about the various investment opportunities that it is putting its resources to. So let's look at the very first one, which is payback. Payback. Let's take a hint, a clue from the name payback. All right. So the first point here says that payback is a simple technique that measures the time it takes for earnings from an investment to recoup its original cost. Very simple. How much time will it take us to get back our investment? We threw some money at it. Here in this example, the outflow here is $500,000. There is an investment. It will cost us $500,000 to buy the machine, to set up, to train our workers, etc. So our cash outflow is $500,000 in the first year. In that first year, this investment will give us $100,000 back. We have not recouped. In the second year, it will give us 200,000, a total of 300,000. We have still not recouped our 500,000. In the third year, we made another 200,000. That makes a total cumulative cash inflow of 500,000. So, what is the payback? The payback is 3 years, and payback is calculated in years. The payback is 3 years. Very simple. Very simple. Second point, before I skip something important, it says it calculates the number of years it takes to recover the cost of an investment from its earnings. That's what we've just looked at. These are the earnings from the various years: year 1, year 2, year 3. In the first year, the cash outflow is 500,000. It cost us 500,000 to invest in this opportunity. Whether it's buying another company, buying an asset, all these are investments. How long will it take us to recoup our investment or recover our costs? It will take us 3 years, because year 1 gives 100, 200, 200, and then year 4 is 150. So everything after year 4, everything after year 3 is our profit. And the last point says, because of its simplicity, it is quite common, especially with small business. Please change this to with. It should be with. Because of its simplicity, it is quite common, especially with small businesses. And it is simple, isn't it? It's very simple to calculate. We just want to know how many years will it take us to recoup or recover our investment. But it's not always straightforward. So let's look at a more complex example. Let's look at a more complex example. So here, the cash outflow in the first year is 500,000. So in year one, in that same year, we received 100,000 from the investment. Year two is 100,000 also, making a cumulative cash inflow of 200,000. Year three is 200,000, making a cumulative cash inflow of 400,000. But in year four, it is 300,000. So, how many years did it take us to recover our investment? You can't say it is 4 years. Why? Because this 300,000 is at the end of the fourth year. All right. In year one, this 100,000, not all of it is in January. Not all of it is in February. It is spread across the year. This 100,000 in the second year is also spread across the year. And then this 200,000 in year three is spread across the third year from January to February if it is using the traditional calendar month, a month in the year. And then year four is 300,000. So this is also spread across the year from January to December. So if you say it takes us 4 years, it could be that even by the end of the first month, we recouped our investment of 100,000. But how would we know? We have to use this formula. We have to use the formula below. Let's read first. It says, in this case, payback is achieved during the fourth year, obviously. The formula used to calculate the point, we want to know the specific point in the year, the specific point during the year at which payback is achieved. And to do that, payback is calculated by adding the number of full years. And here the number of full years is what? It's 3 years. In these 3 years, all this is considered full years because all this swallows our cash outflow. All right. So this is a cumulative of 400,000 by the third year. All right. So in 3 years we make 400,000, but in the fourth year we use this fraction. We use this fraction to calculate the specific point in the fourth year that we will recoup our investment, and it's the amount of investment not recovered divided by the revenue generated in the year. So I have a question for you. What is the amount of investments not recovered by the fourth year? I have a question for you. What is the amount of investments not recovered?
I'm not sure.
You should be sure. In the first year, you see, our cash outflow is 500,000. Now we have recovered 100,000 of it here. Does that make sense? It does. I think it does. You've muted your mic, so I can't expect a response. Then number two, in the second year, we've recovered 100,000 of our 500,000. Then in year three, we have recovered 200,000 of our 500,000. Cumulatively, if we add all of this, we have recovered 400,000 of our 500,000. My question is, in the fourth year, we are expecting a cash inflow of 300,000, but 300,000 is more than, I mean, if we add 300,000 to what we've already received, that's going to be what? 800,000. But our cash flow is not 800,000. Our cash outflow is not 800,000. It's 500,000. So my question is, at the end of the third year, which amount of our investment is not recovered? I think it's clear now. Is my question clear now?
No, no,
It's not
it's
clear?
not. Yes.
Please keep your mic on so that we can deliberate.
Okay.
Yeah.
Okay.
All right. So there's this machine that this business wants to buy. The machine is $500,000. Um, when we use the machine at the end of the first year, the machine gave us $100,000. So how much do we have unrecovered from our $500,000?
400.
Very good, 400. Second year, we've made another 100,000. So that makes a total of 200,000. How much is unrecovered from our 500,000?
300.
Yes. Then the third year, we have made 200,000, a cumulative of 400,000. How much is unrecovered from our 500,000?
100.
100,000. So the formula says that put the amount unrecovered here in the numerator and then divide it by the revenue generated in that year, which is the fourth year. So our numerator will be 100,000. Our denominator will be 300,000. Does that make sense?
Mm-hmm.
All right, so calculate it. Remember, don't skip the number of full years. The number of full years is 3 years. So we have 1, 2, 3, which is 400,000 is recovered from these 3 years. So number of full years is 3 years plus, then calculate this and add it to the 3 years. Please do it quickly so that we don't waste so much time.
Okay.
All right.
Is the answer 4?
No. 100,000 divided by 300,000 gave you what? So the amount of investment not recovered here will be 100,000, right?
Okay.
It's difficult to draw with my mouse, but I'll try. Divided by the revenue generated in the fourth year is 300,000. So what is 100,000 divided by 300,000?
All right. 0.00. I mean 0.33333, and
Yes,
they go on.
plus the number of full years.
4.333333.
No, 0.3333 plus the number of full years is not 4 years, it's 3 years.
Oh, the answer would be 3.333.
Yes, 3.333. So that's um that is correct. That's the calculation of our payback. So how much or how long will it take for the investment to be paid back? It is 3.333 years. All right, 3.33 years. 0.33 times 12 should give us 4 months. I hope that makes sense. All right, so it is 3.33, like you said. The decimal there, 0.33333. If you multiply that by 12 months, will give you 4 months. All right. I think that I have to put on my second camera so that you understand what I'm saying. Just give me a sec. So let me take this off for a second. All right. Can you see my second camera?
Yes.
All right. So the formula was payback is equal to the number of full years plus into bracket amount unrecovered divided by revenue generated in next year. Here's the formula. And these are the years. Year one, we spent 500,000 on the investment. This is outflow, cash outflow. Let me use a pen so that it's visible. And then cash inflow. In that same year, whilst we spent 500,000, we made 100,000 from whatever investment it is, whether it's a machine we bought, whatever, we don't know. So two, there's no cash outflow. We don't spend any money more on the investment, but the investment yielded 100,000. So here the cumulative amount is 100,000. Here the cumulative is 200,000, because if we add 100,000 to this 100,000, it makes 200,000. And then in year three, we made 200,000. So we have a cumulative of 400,000 in year three. However, in year four, we made 300,000 from the investment. So the cumulative amount here now, if we add 400,000, is 700,000. The 700,000 is more than the 500,000 that we invested. So we want to know at which point in the fourth year did we recoup our investment of $500,000, because payback is about recouping. We want to calculate the number of years it takes to recoup. If we say it is 4 years, it's not very accurate. Which month in the fourth year did we recover our $500,000? Because by the end of the fourth year, we would have made $700,000, which includes some profit. And that's where we use the formula. So the number of full years, that is, why do we call it full years? The number of years that we used all the inflows. That is year one, year two, year three. So we have 3 years. So we have 3 years plus the amount unrecovered, like you said, is 100,000 divided by the revenue generated in the next year is year 4, which is 300,000. And like you said, it will give you 3 years plus 0.3333. All right, so it's 3.33333 years. All right, so 3 years makes sense. But what is 0.3333 of a year? There's nothing like 0.333 of a year. We want it in months. So we multiply 0.333333 times 12, because there are 12 months in the year. All right, so 0.3 is a decimal, which is a fraction of a year. All right, a fraction of the year. What fraction is 1/3 of the year? 0.333 is 1/3, because it's 100,000. This will cancel, all this will cancel, all these zeros. So it is 1/3. What is 1/3 of a year? 1/3 of the year is 4 months of the year. Do you agree with me?
Yes, I do.
Very good. So that's all that payback is about. So let me go back to our slides. Oh, all right. So that is a more complex example of payback. Now, this is a simple example where in the third full year, all the cost was recovered, all our outflow, our investment was recovered. But here is a more complex example. When you have the more complex example, you have to use this payback formula. Payback can also be shown on a graph, but I will do that in class. Please remind me to draw the graph from scratch so that we can use payback on a graph, but it will take us just a few minutes. Not very important, but we can also use the graph to calculate payback, and I'll demonstrate that in class when I have access to the board. All right, so let's look at the advantages and disadvantages of payback. Number one, it is very simple and it is quick. That's the first advantage. So because of that, it is liked by small businesses. Because it's simple and quick, it's liked by small businesses. It doesn't require any advanced financial mathematics that a small businesswoman will not be able to do. Now, let's look at the disadvantage. It ignores the level of profit that may be ultimately generated by the investment. So if we go back, the calculation here, that we don't care about the profits. The calculation did not care about the profits that made. All right. Even though the entire inflows is 700,000, making a profit of 200,000, that is if we compare 700,000 to the 500,000 cash outflow. We don't care about that. We don't care about the profits. So payback does not factor in profits made. So that's a major disadvantage, that it ignores the level of profit that may be ultimately generated by the investment. The second disadvantage is that payback ignores the timings of receipts before payback is achieved. It ignores the timings of receipts before payback. Let's look at an example. So we have an investment A. Investment A is 100,000. That is the cash outflow. The investment is 100,000, whatever it is, a machine, another business, buying land, training, investing in new technology, whatever that investment is, it is 100,000. These are the returns. The returns is 20,000 in the first year, 20,000 in the second year, the second to fifth year actually. So there's 20,000 in the first year, 20,000 in 2 to 5 years. So every year is 20,000 basically. That's investment A. Investment B is also 100,000, but it returns 10,000 in year 1 to 4, compared to the 20,000 in investment A, and then 50,000 in year 5. If you calculate the payback for both investments, they all have a 5-year payback period. Let's check. In the first year for investment 1, we have 20,000. In year 2, we have 40,000. In year 3, 60,000. In year 4, 80,000. In year 5, 100,000. So 5 years to recoup our 100,000. In investment B, it also takes us 5 years. Let's check. 100,000 in the first year, 20,000 in the second year, 30,000 in the third year, 40,000 in the fourth year, and then 50,000 in the fifth year. 50,000 in the fifth year. So both investments have a payback of 5 years, but investment A is better because it provides earlier returns. However, payback ignores that also. So it ignores profit levels and it ignores the timings of any receipts. Let me go back and use this chart. Let's assume that the cash outflow is 500,000, and then in the first year we made 400,000 of that 500,000, 400,000, and then in the second year 10,000, 10,000, and probably in the fourth year we made the remaining of our 500,000. That is better than making 100,000 in the first year compared to making 400,000 in the first year. I hope I'm doing a good job explaining this disadvantage.
Yes.
All right. So These are the advantages and the disadvantages of payback. The next one is to talk about the accounting rate of return. This is the second one, but I will not go into it today. It involves calculation, and I think that it will be better we do it on the board. These are the formulas. It's very a little complex compared to the payback. So I would wish that I will take our time and then we would answer this case study where we will calculate payback, we will calculate the ARR, which is the accounting rate of return, and then we would analyze, sorry, and then we'll do some analysis of of our calculations. All right. So remember, we are going to look at three ways. Let me go back. Three ways. Today we have done payback. Next time we'll look at the accounting rate of return, and then after that we'll look at the discounted cash flow model. Any questions on payback?
No questions.
All right. See you then.
Okay.